For the past 2 days, something has felt deeply wrong in the markets. Not a little volatile wrong, not healthy correction wrong. More like the kind of wrong you feel in your gut when the smoke alarm goes off at 3 a.m. and you can already smell something burning. We've been piecing together clues. The sudden crash to $86. The U.S. Mint quietly shutting its doors. The bizarre $13 premium in Shanghai. Each one on its own could be explained away. Together they form a pattern. Not noise, a signal. Like distant thunder before a storm breaks overhead. But this morning, that storm may have finally come into view. Circulating across institutional trading desks is a highly controversial, completely unverified ledger. It has gone viral in the quietest way possible. Whispered, forwarded, not posted. And what it claims is nothing short of explosive. According to this document, two of the largest banks in the United States, Bank of America and Citigroup, may be sitting on a combined shadow short position of up to 4.4 billion ounces of silver. Let me repeat that, because the brain tends to reject numbers this large the way the body rejects bad sushi. 4.4 billion ounces. That is not a typo. That is not a rounding error. That is a number so big it starts to sound like science fiction. Now, officially, the Commitment of Traders report shows roughly 500 million ounces of short exposure. That alone is massive. But if this leaked ledger is even remotely accurate, it suggests something far more dangerous, that the banks may be hiding an additional 4 billion ounces in off-balance sheet derivatives buried in the opaque world of over-the-counter contracts. If true, this is not just bad positioning, this is a structural failure of the market itself. To understand why, you have to step out of spreadsheets and into physical reality. The entire global mining industry, every mine in Mexico, Peru, China, Russia, Australia, all of them combined, produces about 800 million ounces of silver per year. That is the hard ceiling. You cannot print silver. You cannot stimulate silver. You cannot hold a press conference and mine an extra mountain by Tuesday. So do the math. If global supply is 800 million ounces per year, and these banks have allegedly sold 4.4 billion ounces, they have sold 5.5 years of future production. They have sold silver that does not exist. They have sold silver that will not exist until 2031. This is not ordinary short selling. In a normal short, you borrow an asset that exists, sell it, and hope to buy it back cheaper. Keyword, exists. You need to be able to find it. So where exactly are Bank of America and Citigroup supposed to find 4 billion ounces of silver? They can't find it at the COMEX. Registered inventories are down near 120 million ounces. They can't find it at the U.S. Mint. The Mint has suspended sales. They can't find it in London. Vault reports show steady depletion. This is not a liquidity problem. This is a geological problem. Whether the real number is 500 million ounces or 4 billion, the banks are trapped in a mathematical prison of their own making. And suddenly, Thursday's violence in the market makes a lot more sense. Remember that flash crash? Silver plunging from $92 to $86 in minutes? We were told it was profit-taking. We were told it was technical resistance. That explanation now sounds like calling a house fire a minor cooking incident. That move had all the fingerprints of a survival trade. If you are short 4 billion ounces, every $1 rise in silver costs you 4 billion. When silver ran from $50 to $90, that's a $40 move. $40 times 4 billion ounces equals $160 billion in losses. That is not a bad trade. That is an extinction level event. They didn't smash the price to make money. They smashed the price to stop the bleeding. They were trying to dodge a margin call that could have liquidated the institution. But here's the fatal flaw in a naked short of this magnitude. It creates a black hole in the market. Because they have sold multiples of annual supply, they have created future demand that is larger than future production. At some point, they must close these positions. They must buy silver. From whom? From you? From Samsung? From the Chinese government? Nobody is selling. This is why the price rebounded so quickly. The market is starting to realize that short interest is not selling pressure. It is future buying pressure. These banks are not sellers of silver. They are guaranteed future buyers of silver. They just haven't admitted it yet. This flips the narrative completely. We are not looking at an overbought market. We are looking at one of the most oversold markets in financial history. If the shadow leverage is real, short interest relative to annual production could be over 550%. For comparison, during the Volkswagen squeeze in 2008, short interest was about 12% of the float, and the stock rose 500% in a day. During GameStop, short interest hit 140%, and the stock rose over 1,000%. Now imagine a short position that dwarfs both of those combined. The potential energy in this trade is not a spring, it is a nuclear reactor. And this leads to the most dangerous part of the entire story, counterparty risk. If you hold a paper silver contract, who is on the other side of that trade? A major bank. If that bank owes billions of ounces and controls only tens of millions of ounces, then it is not illiquid. It is insolvent. That means paper silver holders may be holding a promise from an entity that cannot perform. This explains the growing disconnect between paper and physical markets. When dealers charge $120 for a coin while spot trades at $90, they are not being greedy. They are pricing in default risk. They are quietly admitting what the paper market does not want to say out loud. Some of these contracts may be fiction. For years, we talked about manipulation, spoofing, capping, games at the margin. This is different. This is not manipulation. This is recklessness on a scale that threatens the financial system itself. These banks appear to have bet the house against silver, and silver is winning. Now we must do the math that polite television refuses to do. Take silver at $90 an ounce, multiply by 4.4 billion ounces. You get 396 billion. That is not a trading loss. That is a solvency event. Now compare that to the value of the banks themselves. Citigroup's market cap is roughly $120 billion. Bank of America's is about $260 billion combined, around $380 billion. Their potential silver liability is larger than the total value of both banks. If they were forced to cover today at $90, their equity would be wiped out. Shareholders, zero. Institutions, technically bankrupt. And that assumes the price would stay at $90 while they tried to buy 4 billion ounces, which is like assuming the price of umbrellas stays flat during a hurricane. In reality, the price would explode. $200, $300, $500. The liability is not $396 billion, it is theoretically infinite. This is why Thursday's move was so violent. When silver hit $92, risk systems likely lit up like a Christmas tree. The liability was crossing thresholds tied to Tier 1 capital. Margin calls were looming. They had two choices. Choice A, admit defeat, cover the shorts, launch silver into orbit, and declare bankruptcy. Choice B, liquidate everything in sight, smash the price, buy time. They chose B, but time is not metal. You cannot settle a futures contract with time. Eventually, the math wins. Markets can ignore reality longer than seems reasonable, but they cannot ignore it forever. And when the reckoning comes, it will not be polite. What happened next tells you everything you need to know about how desperate this situation has become. When the price was smashed from $92 down to $86, it wasn't some clever trading strategy. It was emergency surgery without anesthesia. By forcing silver down $6 in minutes, they didn't correct the market. They bought themselves oxygen. $6 per ounce multiplied by 4.4 billion ounces equals 26.4 billion. With one violent move, they reduced their paper liability by $26 billion. That is not profit. That is survival. That is the financial equivalent of selling the furniture to make this month's rent. Enough to keep the margin clerk quiet for one more day. Enough to keep the lights on for one more night. This was not a trade designed to win. It was a trade designed not to die. But here's the problem with using a fire extinguisher on a volcano. The price didn't stay down. Silver ripped straight back to $90, and just like that, the $26 billion of temporary relief evaporated. The wound reopened. The bleeding resumed. They are right back where they started, except now their arsenal is depleted. They've already shown their hand. The shock and awe smash no longer works the way it used to, and while they are busy fighting a paper war on computer screens, the physical market is sending a far more dangerous signal, one that quietly confirms the situation is already past the point of comfort. That signal is backwardation. Normally, silver trades in contango. Futures prices are higher than the spot price because it costs money to store, insure, and secure metal. Silver delivered 6 months from now should cost more than silver delivered today. That is how a healthy, functioning commodity market behaves. But right now, the market is flipped upside down. Spot silver is more expensive than futures silver. That is backwardation, and in precious metals it is extremely rare and extremely serious. It means buyers are willing to pay a premium to get metal now, not later. It means they do not trust future delivery. And it gets worse. Lease rates are exploding. A lease rate is the cost to borrow physical silver. If you are a bank and you are short, you can try to lease silver to make delivery and kick the problem down the road. But when lease rates go vertical, it means there is no silver available to borrow at any reasonable price. The message from metal owners is simple. No, you can't have it. We're keeping it. This is the physical market screaming that a shortage is real. Now combine these pieces. A multi-billion ounce paper short, a physical market in backwardation, lease rates surging. This creates a death spiral. The banks need silver to cover their shorts, but they can't borrow it because nobody will lend it, so they must buy it. But they can T-buy it because the price is too high and they are already financially stretched. So they try to smash the price. But the smash fails because physical buyers step in immediately. It is a trap with no exit. This is no longer just a silver story, it is a systemic risk story. Bank of America and Citigroup are not ordinary banks. They are global, systemically important banks. They are the plumbing of the world financial system. If they fail, derivatives freeze, credit freezes, and suddenly very normal people start discovering that ATMs are not as automatic as they were promised. This is why the Federal Reserve and the U.S. Treasury are not spectators. They know about this exposure. They have seen the data. Why do you think emergency G7 calls are happening? Why do you think the U.S. Mint suspended sales? These are not coincidences. These are containment measures. They are trying to manage the collapse of a massive short position without detonating the dollar at the same time. They are attempting the impossible task of engineering a soft landing for a 4 billion ounce bomb. But there is no soft landing for a naked short in a physical shortage. There is only a hard landing. The only way to save the banks is a bailout. The Federal Reserve will have to print hundreds of billions of dollars, likely far more than 390 billion, to absorb these losses. The silver short will be monetized, which means silver is not just rising because of supply and demand. It is rising because it is being repriced against a currency that must be diluted to save the banking system. We are watching the early stages of one of the greatest wealth transfers in history, from institutions that sold paper promises to individuals who bought physical metal. The insolvency equation is brutally simple: 0 for the banks, infinity for the metal. But events like this do not happen randomly. They follow a rhythm. To understand why this is happening now, January 2026, and not earlier or later, we have to step back from balance sheets and look at history and S clock. There's a chart that has circulated quietly among elite macro investors for decades. It is not generated by algorithms or artificial intelligence. It was drawn by hand in 1875 by an Ohio farmer named Samuel Benner. Benner noticed that financial panics, commodity booms, and market crashes followed repeating patterns. He mapped them out over long cycles. His work became known as the Benner cycle. For more than 150 years, this chart has aligned with major turning points. It pointed to the panic of 1929. It marked the bottom of 1932. It aligned with the dot-com peak in 2000. It lined up with the crash of 2008. And when you look at the chart today, there's a circle around 1 year, 2026. Benner labeled it as a year of good times, high prices, and the time to sell stocks and values of all kinds. That doesn't mean comfort. It means climax. High prices mark the blow-off top, the peak of confidence just before collapse. It is the moment when smart money exits paper assets before the fall. The banks ignored this signal. They built enormous short positions in silver on the assumption that the paper age would never end, that stocks and bonds could rise forever while commodities stayed suppressed. They bet against the cycle. But the Benner cycle describes capital rotation. Wealth moves out of paper assets and into hard assets at major turning points. It happens when confidence in the financial system is highest, right before it breaks. We are living through that pivot point. The silver squeeze is not an isolated accident. It is the mechanism through which the cycle enforces itself. Think about the irony. The banks are short silver. That means they are betting that hard assets will fall. But the cycle says we are entering a period where paper assets deflate and hard assets explode. They are trying to hold back an historical tide with spreadsheets. This is why they are trapped. They didn't just make a bad trade. They misjudged the economic season. They are planting seeds in winter. We are talking about hundreds of trillions of dollars in global capital that must rotate. It cannot hide in bonds because inflation destroys bonds. It cannot hide in cash because currencies are being diluted. It must go somewhere real. It must go into commodities. That is the commodity supercycle. And the banks are short the supercycle itself. And why did they do this? Not stupidity, arrogance. They believed that because they could create unlimited paper contracts, they could override supply and demand. They believed they could override history. This is the same hubris that preceded every major collapse. In 2008, they believed housing could never fall nationwide. In 2026, they believed silver could never break $100. Both times, the cycle proved them wrong, but this time is harder. In 2008, they could print money to fill the hole. This time, the hole is physical metal, and you cannot print silver. The past is warning the present. Moments of extreme confidence are always followed by years of adjustment. The bill has arrived. This time, the banks cannot pay in promises. The phrase hard times depends entirely on which side of the trade you prefer standing on. For the people who trusted paper promises, yes, hard times are coming. For those who stayed in stocks too long and believed the banks were permanent and risk-free, the next phase will be painful. But for those holding real assets, silver, gold, land, this is not a crisis. This is a transfer. History is not kind, but it is consistent. It always moves wealth from the careless to the prepared. Right now, the banks are desperately trying to extend the paper boom for one more month, one more week, one more day. That is why they smashed silver to $86. Not because the market demanded it, but because time demanded it. They are trying to slow a calendar that only moves forward. It is 2026. The cycle has arrived. The great rotation from paper to metal is no longer a theory. It is happening in real time. The leaked ledger shows us the scale of their bet. The historical cycle shows us the futility of their bet. They have wagered 4.4 billion ounces of silver that history is wrong. That is not a bet I would make. This context matters because it tells us that the chaos we are seeing is not random. The violent swings, the sudden crashes, the instant recoveries, this is not disorder. It is the sound of a system changing form. It is the grinding of tectonic plates beneath the financial world. The banks are standing on the sinking plate. The holders of physical metal are standing on the rising one, which brings us to the end game. If the banks are insolvent, if the cycle has turned, and if the metal is gone, how does this end? How does a bank exit a trade when it owes metal it cannot buy and cannot borrow? There is only one escape hatch left. It is buried in the fine print of futures contracts, ignored for decades because no one thought it would ever be used. Force majeure. In plain English, cash settlement. This is the final move when delivery becomes impossible. Force majeure means superior force. It is meant for earthquakes, wars, and natural disasters. But soon, it may be used to describe a disaster of the bank's own making. They will claim that extraordinary market conditions, overseas demand, retail hoarding, supply chain stress, have made delivery impossible. Then they will pull the lever. Every futures contract contains a clause that allows the exchange to settle in cash if physical delivery cannot be made. This is the nightmare scenario for paper holders. Imagine you bought silver futures at $30. The price runs to $90. You think you've won. You stand for delivery because you don't want paper profits. You want metal. Instead of a 5,000-ounce bar, you receive a check for the dollar difference. They smile politely and say, "Contract closed, congratulations." You made money and you lost everything. Because you didn't want dollars, you wanted silver. By the time that cash hits your account and you try to buy physical metal, the street price is $150, if you can find any at all. You were cashed out at an artificial price while the real asset moved out of reach. This is already starting. Industrial buyers are reporting 6-week delays. Dealers are quoting unavailable on large orders. When a wholesaler says 6 weeks, what they really mean is, we hope we can find it by then. That is a soft default. Force majeure would be the hard default. And when it happens, the separation between paper and physical becomes permanent. The comic's price becomes a museum exhibit, a historical number that no longer clears real metal. Meanwhile, the street price goes vertical. Our analysis suggests that when the first major short officially declares force majeure, physical silver gaps from $90 to $150 almost overnight. Why $150? Because that is where panic becomes universal. That is the price where industrial giants stop trusting the paper market and start bidding directly against each other for remaining supply. When Samsung and Tesla compete for bars instead of contracts, price discovery changes forever. This is what a commodities supercycle really means. It is not just a bull market. It is a period where real assets become the dominant form of collateral in the global system. Paper wealth fades. Tangible wealth rules. Those who control the metal make the terms. The banks fear this because their power is built on paper. If paper loses credibility, their business model collapses. But cycles do not ask permission. The insolvency equation must be balanced. So what does this mean for you? You are standing at the edge of the largest wealth transfer in modern history. But participation requires one simple rule. Do not accept cash settlement. If you own physical silver, you are already outside the system. You hold the asset the banks owe but cannot deliver. Do not hand it back to them cheaply. The volatility, the crash to $86, the spike to $90, is designed to shake metal out of strong hands. They need your silver. It is the only thing that can save them. If you sell at $90, you are not taking profit. You are bailing out Bank of America and Citigroup. You are handing them the life raft they need to survive the storm. Hold your position. The real price of silver is not on a screen. The screen is a story maintained by algorithms that are about to be switched off. The real price is determined by availability. How much is something worth when you cannot replace it? What is a missile worth if you cannot build it? What is a solar panel worth if you cannot source its components? Silver is not just a trade. It is the backbone of the modern industrial world. And the banks have shorted the future itself. They promised to deliver tomorrow's metal, but they sold it all yesterday. That is why force majeure is inevitable. When the announcement comes, next week or next month, do not panic. Ignore the anchors who say the market is frozen. The freeze is the confirmation. It means the paper game is finished. Price discovery is moving from New York to Shanghai, from derivatives desks to physical vaults. We are watching the death of illusion and the return of reality. The banks are sitting on a $390 billion mistake. Do not let their mistake become your loss. Let it become your gain. The vaults are emptying. The cycle is turning. The age of real money has begun.